Right, student, good morning. Today we are going to continue our discussion on chapter 10. So on Tuesday, we have discussed the NPV, net present value for budget variation. I hope you are okay with the NPV. For me, I think should be okay. But in this chapter, our focus will be other method for project decision. And we like to focus on advantage of other method, right? And you know, advantage of other method will be disadvantage of NPV, right? So we have discussed payback period on Tuesday. Now we are going to discuss accounting rate of return, right? So accounting rate of return, this is the definition. So accounting rate of return, or ARR, can be calculated in number of ways, but in this class, we use this definition, right? So ARR is average net income divided by average book value, right? So here, average net income. So consider we have an N-year project, and the project can provide us the net income every year, year 1, year 2 to year N. The average, we just add it up using simple average, right? So you can find the first problem. We don't consider the time value of money, right? So net income every year, added up, average, no time value of money. So this is the first problem of accounting net income. Next, average book value. So again, for the project, the asset has a value. We use the book value, right? Later, I will discuss the difference between book value and the market value. All right, so if we use a book value, right, the asset, book value at year 1, year 2 to year N. Again, simple average. N is a project life, all right? So I have two notes for you. First, net income. Accounting net income is not equal to finance cash flow, right? So we addressed this point before, right? Later on, I will show you the detail later. Second, book value is not equal to market value, right? So in accounting, they use book value, but in finance, our focus is market value, right? Later, we will discuss the difference between them and why finance people use market value, right? So if you are okay with ARR and you know the 2 points, net income is not equal to cash flow, book value is not equal to market value. So let's go to the next slide. So you can see we have a 3-year project, right? So we have cash flow year 0 to year 3. But in the accounting rate of return, ARR method, we don't use cash flow, we use net income, right? So first observation, net income is not equal to cash flow, right? Then we have the average book value of the project. Here is the number, right? So in the NPV, we use the required return, and required return depends on the risk. But in the ARR, accounting rate of return, we don't consider risk. You can see we just use the simple average, all right? So here we have 2 points. One, net income is not equal to cash flow. Book value is not equal to market value. So I like to use my handwritten note to explain the 2 differences to you. So let's review our accounting 101, how to calculate net income or accounting profit, right? So accounting profit is top sales. Then we have 0 costs. Sales minus costs, we have income or accounting profit, right? But accounting profit is not equal to cash flow. So let's see the cost in accounting, all right? So sales minus cost of goods sold minus depreciation. Then we have earning before interest and tax, or EBIT. EBIT minus interest and the tax, we have the net income. All right, so for me, it could be easy to understand. Again, I use myself as an example, right? So family is a business, all right? So sales, like my income, my salary, all right? Then I need to go for shopping every 2 weeks to pick and save for new work. It's a cost of goods sold to buy some inventory, all right? Depreciation. So this is the key. In accounting, they use the depreciation to recognize the cost of the long-term asset. For example, my house, $500,000. I purchased my house around 10 years ago. But in accounting, they use the depreciation to recognize the cost. For example, I use 20 years for my house. Then depreciation will be 500,000 divided by 20 every year. Right? This is the depreciation. And I need to pay the interest, right, for my house loan. Tax, yeah, we need to pay tax to the government. So finally, I have my net income. But net income is not equal to finance cash flow. Here, I give you 3 reasons. First reason, sales. For a company, their sales include credit sales, right? So that means the company has not received the money, but they can recognize credit sales as the sales, all right? So this is the first reason. Second reason, credit purchase, all right? Final reason, for me, could be the most important reason is depreciation, right? So depreciation is a non-cash expense, right? So this is a key reason why accounting income is not equal to finance cash flow, right? But finance people would like to use cash flow. Accounting people, they use accounting income. But this is a debate, all right? I don't say which way is right? Because for me, like a house, right? We don't recognize $500,000 immediately because house is a long-term asset. We can use 20 years to measure the cost. For me, it makes sense, right? So there's no right or wrong, right? But finance people, we prefer using cash flow. Right? Book value versus market value. So in accounting, they use the book value. But in finance, we consider market value. The difference between them is about time. So let me show you the timeline. So you see myself, example, my house. So market value is the market price of my house today, all right? Book value is the historical value. So think about a timeline. Book value is the value of my house 10 years from now. For example, I purchased my house 10 years ago. Right? So this is the book value. Right? It's historical value. And you know, book value will not equal to market value. The reason? Time. All right. But in finance, we prefer to use the market value, right? Because it's the value today, right? But you know, there's a problem. Market value sometimes is difficult to estimate, right? For example, my house, although I can find some information online about the market value of my house, but it's not easy to estimate a specific number. On the other hand, book value, we have a specific number, right? For example, 10 years ago, I purchased the house, $500,000. It's clear, right? So you can see the difference between accounting and the finance, all right? So let's go back to accounting return. So we have net income, 3 years, and the book value. Then accounting return is easy. We use a simple average, right? So average net income and the average book value. Here we have the result. So average net income, right? 3 years, simple average, right? This is our simple average. And our ARR, accounting rate of return, average accounting income divided by book value. And this is a number. Right? So you can see easy, right? Easy is good, right? Being easy is good. So if we have this number, next we compare this number to our firm's requirement. For example, the firm has a requirement 25% as a threshold, right? And in this project, its ARR is 21%, lower than 25%. So we reject the project. All right. So this is the ARR method. Now we'd like to address the advantage of ARR. So again, the first, easy. Being easy is good, right? We use a simple average, and needed information will usually be available, right? So for example, if your sample is a company, so company need to has the accounting information and financial statement information available in the market. All right. So you have the net income, right? And the net income and the book value, so they are available in the market. On the other hand, NPV, you know, cash flow, estimation of the future cash flow is a problem, all right? And the K, cost of capital, estimation of cost of capital is another problem, right? So in chapter 10, we give you the cost of capital directly, but you know, in chapter 11, we are going to show you how to estimate the cost of capital. All right. Disadvantage, right? So ARR has some disadvantage or some problem. First, not true rate of return, and the time value of money is ignored, right? And use an arbitrary benchmark cut-off rate, like our payback. We need to have a threshold value, right? It's arbitrary. That means it's not decided by the data itself, all right? And based on accounting net income and the book value, not cash flows and the market value. Okay, we finished the accounting rate of return. Now our next topic is IRR, internal rate of return. Right. So what's the internal rate of return? Here is the definition. So internal rate of return, it is a discount rate or the required return that will bring all the cash flow into present value time and the total, the exact value of the cost of the project. Right? This sentence could be too mouthful, it's too long. So I use another way to show you what is the internal rate of return. So internal rate of return is the return that will yield a zero NPV. All right. So this internal rate of return or IRR. So when I see the IRR, I know this is the return that will create or yield a zero NPV. Right. Now, how to calculate the IRR? We have three methods: trial and error, financial calculator method, and Excel. So in our class, I would like to focus on Excel, the IRR formula, because it's easier. But I will also introduce or discuss the trial and error method. So let me show you my slide, and you can understand how to use the trial and error method. So this is our timeline. This is a 10-year project, right? So we have the cash flow every year. Initial cash outflow, the initial cost of the project is here, negative outflow. Then we have the NPV result. So what is IRR? IRR is a special return that will create a zero NPV. So you can see I replace our cost of capital with IRR. All right, and we have zero NPV. Right. So it's difficult to find the IRR directly. So we use the trial and error method. For example, we have cash flow here, IRR, let's try 15%. right? 50% or 1.5. So 50%, then you have the NPV is here. NPV is positive. To reach 0 NPV, we increase the IRR. So we can try 27.08%. Then we have 0 NPV. So this is our number. Right? But you might ask me why we know this number, 27.08%. So this is a problem. How can we know we can catch up this number directly? Impossible. So just let you know, we have this method, trial and error. So we like to use the the IRR formula to do the calculation. So this is our 3-year project, right? Then our required return is here, 12%. So you can see in this project, we have non-constant cash flows, right? Multiple cash flow, and they are not a constant. So NPV is here. We use the NPV formula. This number is positive, so we can accept this project. For the IRR, we use the IRR formula. So here is a detail. IRR formula, B2 to E2, our cash flows, right? And the IRR is higher than the cost of capital. Then we accept the project, right? So you can use Excel NPV formula or IRR formula to do the calculations. But here I like to address a key point, right? So when you use Excel, I hope you remember this key point. Otherwise, you might make a mistake. So the key is the cash flow at T0. In our Excel sheet is our B2 number, all right? So you can see in the NPV, we don't put cash flow at CF0 in the NPV formula. So you can see our NPV formula is here. B4 is our required return. C2 to E2, they are our cash flow year to cash flow at year 3. B2 is outside the NPV formula. So this is the point. The reason, cash flow at 0, right? CF0 is money per day. It doesn't need discount, all right? So don't put CF0 in your NPV formula, right? So this is the point. But in the IRR formula, you will include CF0 in the IRR formula. So you can see in your IRR formula, we have B2 to E2, all the cash flow, including CF0. All right, so this is the point. All right. So IRR decision rule. So if IRR of a project is greater than the first cost of capital, then we accept the project. So here we give you the explanation. IRR, internal rate of return, is an internal return of the project. Right? So it's a return of the project, internal. All right? On the other hand, cost of capital. Cost of capital. In chapter 11, we will show you how to calculate the cost of capital. We use a market data to calculate the cost of capital. All right. So cost of capital is an external return in the market. That means if you don't invest your money in the project, you invest your money in the market can give you the return. The return is the external return or cost of capital in our project variation. So if the IRR is higher than the cost of capital, we accept this project. On the other hand, IRR is lower than cost of capital, we reject the project. All right. So next slide, we'd like to show you the advantage of IRR. So again, I like to highlight the advantage of other method, right? And the advantage of IRR will be disadvantage of NPV. So first, IRR. So people seem to prefer talking about rate, percentage return, right, to dollars of value. So percentage return it's easier to understand, right? So this is the first advantage, right, of IRR. Second, NPV require a market discount rate. So our cost of capital, okay. This is a big work, right? It's not easy to estimate. We will discuss this variable in chapter 11. On the other hand, IRR relies only on the project cash flow, although you do need an estimate of required return to make a final decision. However, if the IRR is high enough, for example, your IRR, internal rate of the project, is 20%, right? The manager will know 20% is very high. That means we can take the project directly. Then we don't need to estimate the cost of capital. So this is the advantage of IRR, okay? Okay, I hope students, you now understand what is IRR. So let me show you the review slide. Let's go through the key concept about the IRR. So IRR, what's the IRR? IRR is a discount rate that gives a project a 0 NPV. This is IRR, right? And IRR decision rule is here. IRR higher than the cost of capital, accept the project. IRR lower than the cost of capital, reject the project. Advantage of IRR, first, easy to understand, right? We use the return, percentage return to make the decision, right? Second, no need to estimate the cost of capital if the IRR is high enough, right? Please note, cost of capital, the K variable, is not easy to estimate. We will address this issue in chapter 11, all right? Okay, our final topic is IRR versus NPV. So our final topic is to compare them again. All right, we like to address the differences between the two methods. So next slide. So when IRR and NPV method agree, if we have independent project and a conventional cash flow. So let's consider what's the conventional cash flow. So a project with conventional cash flow is one with an initial cash outflow followed by one or more future cash inflow. Right? So this is a conventional, or you can say traditional, right? Or usually, right? So usually we have negative cash flow at year 0, followed with positive cash flow by year 1, year 2 to year end. This is a conventional cash flow, right? Then we can use the relation between NPV and the discount rate to discuss this issue. Later, I will show you the relationship between NPV and the discount rate. The result is NPV will decline as discount rate increase, and the IRR and NPV method will result in the same capital expenditure decision. So this is our graph. So you can see this is our NPV formula, right? Then I have the graph. The vertical line is NPV of the project. Horizontal line is our K. And you can see their relationship is negative. That means one is up, the other one is down. The idea is simple. K is here. So when K is up, NPV will go down, right? So we have a negative curve, right? Then let's consider a special case. When K is equal to IRR, this point, our NPV is 0, all right? So this point is IRR for the project, okay? And you can see NPV and IRR will give us the same result. if our NPV curve look like this, all right? The conclusion is here. So in this area, NPV is positive, and your IRR here is higher than K. On the other hand, this area, NPV will go down to here, right? Negative NPV, and your IRR is here, is smaller than K. And the special case is here, 0 NPV, IRR is equal to K. All right, so this is our final conclusion, right? So NPV positive, IRR is higher than cost of capital. NPV negative, IRR is lower than cost of capital. So the two methods will give you the same result, right? And IRR has a beneficial, easy to understand. And if the IRR is higher enough, we don't need to estimate the K, the cost of capital. The next slide, we'd like to discuss the disagreement, right? When IRR and NPV method disagree, we have two situations. First, mutually exclusive project. So what's the mutually exclusive project? That means if we have two projects, but we can only choose one, that means we accept one, then we need to reject the other one, right? Exclusive decision, all right? Right, like your education, right? You study at the Waikato, right? You choose one, then you need to reject other university, right? Exclusive project. Another situation is unconventional cash flow, right? We will discuss unconventional cash flow later. Let's discuss mutually exclusive project. If we have exclusive project, the IRR method will prefer the project with liquidity. Here, I like to review our payback method. So payback method will prefer the project with liquidity. When I see a liquidity, I'm thinking money. That means we receive the money early. And this is good, right? We want to receive money as early as possible. So IRR in the payback will prefer the project with liquidity. All right, so let me use the this Excel sheet to show you the detail, and then we compare the three methods. All right, so this is our project A, project B. We have the cash flow. It's a 2-year project, right? And they are exclusive. That means we can only choose one. All right. The reason is very simple. Your resources is limited. All right. You only have $100. Right. You cannot choose two projects. Right. Only choose one project. Require return 10%. Then I use the NPV formula and IRR formula to do the NPV calculation and IRR. And I also show the payback. All right. So you can see project A, NPV is here, around $36. Project B, NPV around $65. Right. If the two projects are exclusive, NPV method will tell you choose project B because higher NPV. However, when you consider the IRR, you can see project A higher IRR value, and project A payback year 1 because you receive the cash flow at year 1, right? On the other hand, project B IRR 41% and payback year 2. So you can see the result. IRR and the payback method will prefer the project with liquidity. It's good, all right? We like to receive the money early. Not only that, uncertainty of later cash flow. Because uncertainty of later cash flow, you will prefer liquidity, all right? So they are the advantage of IRR and payback, right? Prefer the project with liquidity. Yes, we discuss another situation is unconventional cash flow. Right? If we have unconventional cash flow, IRR and NPV method will disagree. That means they will give us different result. All right. So let's consider what's the unconventional cash flow. If we have unconventional cash flow, our IRR method cannot work. Right. So let me show you the example. So this is the example of unconventional cash flows. Right. So initial cost negative $90,000. And year 1, 2, 3, we have cash flow. But the problem is at year 3, our cash flow is negative again. All right, so we have negative cash flow at year 0 and year 3. Right, this is unconventional cash flow. All right, so required return 15%. Should we accept or reject the project? So you can use the NPV method, but if you use the IRR method, you will face a problem. So let me show you the problem. Here is the problem. If you draw the NPV curve, your NPV curve will look like this. All right, like a U shape, but upside down. All right, then IRR is 0 NPV. So 0 NPV, you can see we have 2 0 NPV. Right? Therefore, your IRR will have 2 numbers. Both of them are incorrect. All right, both of them are incorrect. So IRR method cannot work in this situation. Right? So if you have unconventional cash flow, the best method will be NPV. Right. So let's review a final comment on IRR versus NPV. So IRR method, as noted, is an important alternative to the NPV method. So many businesses are in the habit of thinking in terms of rate of return and whether the rate relates to their ownership portfolio or to the company capital expenditure, right? And whenever there's a conflict between NPV and the decision rule, another decision rule, you might consider using the NPV, particularly when your project has an unconventional cash flow, right? If your project has unconventional cash flow, NPV will be a best method. All right, so again, let me show you the unconventional cash flow. That means your cash flow has a negative cash flow, not just for 1 time, for 2 times, or even 3 times. All right, then you need to use the NPV. All right, but however, we like to address the liquidity issue, right? So if the liquidity issue is your concern, using IRR and the payback will have some advantage. Right? For example, liquidity, that means you need the money as early as possible, right? Then IRR and the payback will be a good choice, all right? Okay, so on this slide, we show you the capital budgeting in practice. So this table shows you the percentage of each method. So you can see the company is a survey, right? 98 of the sample company, they use NPV method frequently or mostly, all right? So NPV method is very good, it's very popular. And but you can see payback period is also popular, 83%. IRR, 98%. Accounting rate of return is not as popular as payback, it's around 51%. But overall, you can see business or company will use all the methods, not just one. They will consider other. The reason is simple. Other methods have the advantage, all right? So we finished this topic. So again, let me review the key concept for you. IRR versus NPV. So NPV and IRR will give us a send, accept, or reject decision. So you can see the decision result here, right? But if our cash flow are unconventional or non-conventional, so non-conventional cash flow, that means the cash flow change sign more than once, you will have multiple internal rate of return, and all of them are incorrect. All right, so you need to use the NPV method. So NPV rule will work fine. All right, so if you have non-conventional cash flow, use the NPV. You don't have other choices, right? Next, mutually exclusive investment decision. IRR and the payback will prefer the project with high liquidity. Right? Okay, we finished the lecture today. We have two more things to do. First, I want to let you know our group assignment is ready for you. So let me address a few points for you about my expectation. All right. So let me show you our Moodle page. Okay, so good assignment. So let me show you my expectation. First, my first expectation is a teamwork. I hope students can work together. So because the good assignment, the question will be longer and more difficult, right? So this is a good assignment. So your first step is to find your good member, right? We have 4 good members at the most. After you have your member already, enter your result to our Moodle page, all right? So you can see enter your good member here. Thank you. We have 89 students choose the group already. There's a point. If you want to join a particular group, you need to obtain an agreement from all existing members. All right. So unlike our tutorial group, the good assignment needed these students work together. You know, we need students work together. So please search for your good member yourself. Right. And we have long answer questions, such as the mini cases and the debate. Right? So I hope students can work together to answer the assignment. All right. And maybe we can show you the good assignment here. So there's one point you have to know. I know some students, you can use the internet or AI to find the answer. I encourage learning after class, but you have to know all submission will go through Turnitin. It's a software to detect the direct copy problem. So you have to write the answer in your own words. If your similarity index is over 30%, you will receive a penalty. Please understand, all right? So you can see, let me show you our assignment question. Right. So you can see our first question is debate. Can cryptocurrency serve as a safe haven asset against stock? It's got the tutorial and the diversification in chapter 7. So this question is related to chapter 7. My expectation is students can review the literature, review some research paper to answer this question. Right. Question 2 is the share variation. Right. We choose a company here. In our question 2 is a Sky Network Television Limited. So you collect the data, market data, and do the share variation yourself. Right. I also ask the student to compare share variation and bond variation. So this question is related to our chapter 8, bond variation, and the chapter 9, share variation. All right. Please specify the sources of your information. Right. Show me how you calculate or how you do the share variation for this company. All right. Question 3 is a mini case. Again, I use myself example. I hope you are okay with that. So find a new job, right? So you have 2 projects, right? New job and current job, exclusive project, right? You can only choose one, all right? Do the NPV, right? And we also discussed the WACC, the weighted average cost of capital, right? This is chapter 11. So question 3 is related to our chapter 10 and chapter 11. Yes. Yeah. Oh no, here I don't. Yeah, Australia the same. Australia salary will be the same. In New Zealand, yeah. It depends on my asset. It just it doesn't mean I will find a new job. I want to just won't use myself example. I don't know. So estimation of cash flow is a big problem. Right? You can see this why we have the cost of capital issue. Right? So my current job, I can estimation of cash flow will be easier. I think every 2 years I might have 4,000 New Zealand dollar as a salary in advancement, right? But in Australia, I don't know. I just get over, but it's very difficult. So here, you address the issue. You address it is part B of our question 3, right? Yeah. Okay. Thank you. We have one more thing to do. If you have question, welcome to approach me to discuss. All right. One more thing before we go, the QR code for attendance. So let me show you the QR code. All right, student, the QR code is ready for you. And online student, I hope you can see the QR code from your end. Right. So enjoy the day and have a nice weekend.